Action.
Hello and welcome to Optotax, where we break down the latest developments, challenges, and practical solutions in GST compliance for businesses and tax professionals. I am your host, Suresh Kumar Jain. I am the VP Finance of Open Financial Technologies, the fintech behind the Optotax platform. In today's episode, we will be discussing the key highlights from the GST Council Meeting, 56th GST Council Meeting, including rate changes, exemptions, compliance updates, and other important decisions that will directly impact businesses across various sectors. To help us understand these developments, we have with us CA Deepak Kumar Jain, who is the tax expert having over 24 years of experience in GST and indirect tax advisory services. He is the founder of Accolet Advisors and IndiaGST.com and actively contributes to industry discussions and policy forums. Deepak, it's a pleasure having you on the show. Welcome. Let's get started.
Thank you so much, Suresh. Let me first thank Optotax for giving me this wonderful opportunity to share my views and enlighten the viewers here. So I also am very privileged to kind of be part of this podcast and be able to kind of bring in certain aspects which may not have kind of been looked at. While from a finance minister's perspective, she's kind of rightly called it as GST 2.0. Right after the implementation of GST, I think this is implementation of GST was considered to be the most radical reform. And I would say from a government's perspective, they're kind of calling it GST 2.0, largely with the kind of, the impact it will kind of bring into every common man is phenomenal. So I think this was a very tough move, and I'm sure I will enjoy my discussion with you. In terms of the structure, what I understand is maybe I'll probably take 10-15 minutes to give my perspective in terms of the changes, and then we'll look at certain questions which can kind of, whatever you would want to kind of raise, I'll be happy to kind of answer them. And I'm sure the audience here, which is kind of, will have certain questions, I'll be happy to kind of answer them as well. Now, in terms of the if we were to kind of look at, while this was through the GST Council, 56th GST Council, as you rightly said, on 3rd, it was stated to be for 3rd and 4th, but I think they worked overnight and kind of brought it on 3rd midnight that way. So if we see the impact it has kind of created on through the rate of taxes, it has kind of touched every segment. Right? I think the government's focus was to kind of look at ensuring that while they have mentioned that it is not consequent to the US tariff, but I think the intention was to kind of ensure that it adds to a lot of fillip to the declining economy, while also giving thrust from a Make in India. So I think if we were to kind of chart out in terms of the way they have kind of, maybe I went a little ahead in terms of the slides. I think for the viewers it may have kind of done. So in terms of if we see, there are 5 main thrust areas which they have kind of brought in. One is to be populist. Certainly, if we look at the rate, I mean, we had 4 rate segments, which is 5, 12, 18, and 28. I mean, as industry, we certainly felt that the 4 can kind of come down to 3. 3 bringing it down to 2 from government certainly was a very bold move. Now you have practically 5% and 18%. The bridge between 5 and 18 is also, I mean, it's become very, very simple, right? So things which you would want to kind of focus are 5, largely the protective segment, and things which are general are at 18. So I think from a government's perspective, I think a really great step, making it to target affordability also. So wherever, be it in terms of bicycles, be it in terms of 3-wheelers, the rate which has kind of brought down from, let's say 28 to say 18, or maybe 18 to 5. Certainly, I think it's a really welcome move, and I'm sure with the way things are going, it will kind of also significantly increase the cash pool in the hands of the common man, which will certainly add to the GDP growth, and which is the very clear intent of these changes. If I, in terms of my reading, there were about 1,700 items which were listed with different rates. Now, they have kind of impacted 25% of them. Basically, the segment which is at 12 and 28, largely whatever was 12 has moved largely to 5%, and whatever was 28 and it had a cess component remains at from a government revenue perspective. I wouldn't say that would kind of cause a lot of dent. But certainly populace in terms of be it the air conditioners, be it in terms of the TVs, will kind of, or the cement, for example, will certainly add to good, I mean, to that particular segment will add to kind of good reform. So maybe if you allow me, Suresh, I'll probably touch base quickly. I understand time is the essence because there has been significant rate changes. I'll quickly go through the various segments which they have kind of touched upon. Then we'll look at the reformative changes which they have kind of done, and then we'll move on to the questions. Now, first, in terms of the agriculture, right? From an agriculture perspective, I think while government's focus largely had to kind of keep the rates to 5%, there were certain products which were taxable at 12. Take, be it in terms of tractors or harvester combine or certain kind of parts, they have kind of brought them down from in most cases now to largely 5.
Right.
Now, if we talk about say tractors and harvester combine also, that particular segment even at 12 was in terms of having an inverted duty. Now, what the government probably when they have kind of done this, I'm sure they have kind of looked about from an inputs perspective also it should not kind of cause more inversion. So therefore, certain parts which basically get into the making of tractors and harvester combine also has kind of got it down to 5%. Right. So I'm sure from an industry perspective, the way they have kind of touched and moved most of them from 12 to 5 certainly is a welcome move. Likewise, from a household and textiles, if we see the 5% or 12% largely was hitting the common man. Now, whatever they have moved from 12 to 5, from a rate perspective, will certainly benefit the common man. Now, in fact, soon after the rates kind of came in, we were expecting how the markets would kind of react. Now, there is where I think few people who have kind of come onto the television and kind of mentioned that when government has brought it down to 5, there is a possible ITC restriction which could kind of come in. Maybe, I mean, we'll have to wait for the notifications if they really bring in, but if government's intent is to really mean that ITC should be flowing free and should not lead to lockup, I would be a little more, I would say, optimistic in my view to say that the ITC restriction will be there, but it will be minimal, which should not kind of impact the larger industry. So largely all the beauty products, be it the tableware, the kitchenware, the hair oil, government has kind of touched upon them and ensured that the rate.
So when you talk about textile, I understand that textile rated above rupees 2,500 rupees has been covered under 28% or 40%. Yeah. Can you tell me what is the rationale behind that and how it would impact the industry as a whole?
Correct. So the textile as a segment had two rates. One is it was earlier 5 and 12. Now they have kind of brought it down between 5 and 18. Right. The value threshold also, what remained at 5% was below 1,000. Now they have kind of increased that threshold to 2,500. So anything which is sold below 2,500 rupees will suffer a rate of 5%. Anything above 2,500 will suffer 18%. So practically for textile, I think among others, it has seen an upward movement. While most segments have seen a lower rate, textile in this case has seen moving from 12 to 18, only for those segments where the rate is more than 2,500 rupees. Likewise, and in terms of footwear also, I think footwear had 5 and 18. It remains at 5 and 18. Just that the value threshold there again, it was below 1,000 was 5%. Now it is below 2,500. It will be 5. So anything above 2,500 rupees for footwear will be 18%.
So would it not impact the brand industry as a whole, where the price of a normal brand is generally considered to be above rupees 2,500? Would that not be something that would take a hit?
Yeah, so see, from a rate in terms of revenue loss, if government had to kind of balance, they have kind of looked at the consumption. So more often, be it in terms of medicines, be it in terms of agriculture, be it, I'm sure we will kind of look at that. There has been a lower movement, that is taxed at higher, after the change is moving to lower. It is only in those select things where government has looked at upward movement. More to kind of look at, maybe it could be consumption, maybe it could otherwise. But there again, I think with 2,500 rupees, certainly they have not hit the common man. They have ensured that those, I would call it as affordable and above, certainly would be paying a higher rate of tax.
Sure.
And in terms of food and beverage also, I mean, largely if we were to kind of see the rates, she in terms of the way she said, I would want to kind of bring about parathas, rotis and all this at 0%. immediately there was a tweet which said that while there is a North and South India divide, while parathas are kept at 0, then you have the dosas which is taxed at 5. But largely from a rate perspective, most of these edible items have kind of been brought to 5. That is really a welcome kind of things. In terms of carbonated and alcoholic and non-alcoholic beverages, there has been certain changes. Rates which were, if it is fruit related or something of those which is non-carbonated, having let's say milk or otherwise, gets reduced from let's say 18 to even 5 in certain cases. But those which are non-alcoholic beverages move from 18 and if it has an element of I would say malt or things which is basically an intoxicating, those move from 18 to 40. Likewise, other beverages like the Pepsi, Coke and otherwise, which were anyways, I mean you had 28 plus a cess of 12, anyways was 40, continues to remain at 40. And here again maybe I'll just touch upon, while government had a clear timeline to remove the cess. So I think they have done it before time. I think that's, I think what they have kind of done is things which is other than tobacco, they have kind of moved the cess away and merged it with ordinary rate. So whatever was cess was earlier kind of going only to states, with cess now merging with ordinary rate. Now center will also start earning from the enhanced rate. So wherever the rate is let's say 40%, earlier the compensation cess was enjoyed largely by the states. Now with the rate becoming 40, center will also enjoy the enhanced kind of tariff that way. And the next was in terms of the automobile. I think automobile was always felt to be taxed at a very high rate. Depending on the size, depending on the CC, the rates were kind of defined. Largely it was between 18 and while it was 18 and 28, with cesses would kind of travel up to 53. So cars, certain which are luxury or SUVs, could kind of get impacted up to 53. Now what the government has done is rationalized completely in terms of the rates there. So most of the rates which are smaller cars will now suffer 18%. Equivalent three-wheelers or certain of those vehicles also now come down to 18. So moving from let's say effective 28 or 29 or 31 to 18 certainly is a straight saving of around 10% in terms of taxes on such vehicles. Likewise, those which were suffering higher, 28 with cesses was kind of going up to 53, right, are now coming down to 40. So to the common man, you could kind of see a huge saving from an automobile segment perspective. So a 10% saving on the value of a high-end car certainly can kind of mean good cash, and which is what I think the finance minister also mentioned, that the intention, while there may be a revenue loss, but with expected savings in cash, it is expected to kind of bring in more kind of purchasing power, which will kind of lead to probably better GDP and better disclosure. So that's where. And in terms of healthcare and electronics maybe I can't touch upon Suresh to all aspects while this presentation is available to your viewers. Therefore, I'm just touching those which I feel may be relevant to the audience. So please allow me to kind of just stress on only those aspects. Sure. In terms of medicines, I think government has rightly classified certain things which are life-saving or otherwise and brought it down either to 5 or 0. Mostly it is 0 in certain identified cases and all other cases to 5. So medicines, bringing it down in terms of rate to from let's say 12 or a rate which is 5 to either 0 or 5 is certainly a welcome kind of. It will impact certainly the health segment significantly. And from a segment which is largely I would say the ones let's say the TV or the air conditioners, right, bringing them down from 28 to 18, right, that also is something which certainly will kind of go to benefit every common man. So that's where I think they have kind of called it rightly as GST 2, right. So certainly as it was impactful on the day of implementation, this is also felt equally impactful because it has that much kind of wide ramification in terms of reach to the number of people it kind of will really benefit. The other segment where it really brings about is in terms of renewable energy in construction. Construction, the one while renewable energy, the focus has been to kind of bring it down to 5. That basically showcased the thrust area of the government. Government really desires to kind of create not only in terms of India but also globally, it wants to kind of create a mark to say bring about. So I think reducing the rate of taxes from 12 to 5 certainly will kind of showcase the dominance which government of India wants to kind of showcase to the world, and also create probably a precedence for other global economies to kind of look at, or government in other, I mean, from a developed countries also. I think a 5% rate, I think, would be enviable for other countries to also kind of follow suit. In terms of construction, the most significant reduction is in terms of cement. I think cement was taxed at 28, and we know that largely real estate, while for the person who's constructing it is creditable, but for the person who's enjoying the construction, it was kind of adding to cost. He could not kind of take credit. So any reduction in taxes will add directly to the benefit of the users. So a rate coming down from 28% for cement to 18 is a huge saving. If you look at the total sales of cement companies, and you take let's say 10% of that, that itself I believe comes closer to about, I mean, numbers may be wrong, but I'm just saying it can kind of be closer to even 10,000 crores.
So are you then trying to confirm that with the reduction of GST from 28 to 18% on cement, there would be direct benefit available to the consumers who would be buying the apartments post this amendment?
Yeah, so any construction, certainly that's the objective. In fact, from a government's perspective, the intention was to kind of look at infra kind of spend. So the intention was through cement or other kind of whatever, in fact granite and marble also has kind of got equally reduced. So certainly the intention is to kind of benefit the ultimate kind of thing. So rate reduction, I just hope that they don't bring in ITC restrictions in a manner which negate the benefit, but we'll have to wait for the notification to come. But as I said, I'm optimistic to say that the reduction is something which will be really real and will kind of go to
but then
benefit the common.
In this construction of apartments which falls under works contract services, there is no overflow of input tax credit that is allowed. So with the reduction from 28 to 18%, still if there is an excess credit balance in the construction industry, how will that be managed?
Yeah, so construction in terms of segment certainly has from the person who's kind of doing the construction certainly can't have an overflow, as you rightly said, but then there is a good gap. So in terms of labor and material, labor largely could be salaries or otherwise, right? So there is a good gap. So the input tax vis-a-vis output tax, most of the construction companies will always have a payment in cash. So any reduction in terms of rate of taxes actually will go to reduce the effective cost of all of this from a construction. So the question would be, see what happens if I'm the developer, no? I'll depend on my subcontractor or contractor to reduce the tax. So certainly from a government's perspective, I mean, when we talk about rate reduction can't be something which happens immediately on a particular date. Right. The industry will kind of look at absorbing them and then passing it on over a period of time. And that's why I think when anti-profiting was kind of discussed or deliberated, I think that was also a thought process. Do we mandate it in terms of law, or do we kind of keep it as, from an industry perspective, as self-policing? I think choicefully they have kind of considered saying that let's keep it as self-policing, because like say if I'm the consumer, it is in my own interest that I negotiate with my supplier. So it is from that perspective. See, if you kind of keep it regulated, what happens is we know how regulations can kind of be misdirected, right? And sometimes it really, the cost of regulation can kind of sometimes add to a lot of nuisance. And rightly so, anti-profiting was required at the time of implementation of GST, because it was certainly a kind of an amalgamation or a merger of many statutes. At this juncture, I think while the thought or the discussion happened, but rightfully so, they have kind of kept it for the industry, more of a self-policing to kind of pass it on. I think that's what hopefully would kind of eventually happen. Likewise, in terms of transportation and other services, they have kind of touched upon. Transportation in some cases, be it in terms of, let's say, if I'm traveling by a business class, the rate enhances from 12% to 18% now, because the rate, any rate which was liable to tax at 12 now has vanished. It either finds its place either in 5 or 18. Likewise, anything which was at 28 had to kind of come down to 18 or go up to 40, and which is what I think government has done. So to my mind, about 300 or 350 line items in terms of the rate notification has seen the impact, and that's a straight benefit, because largely they have kind of brought it down. And the other much talked about was on the health insurance. On the health insurance, it was largely it kind of came in terms of debates in Parliament as well. While government certainly wanted to, we don't have a social security in India, So from a common man, insurance was always kind of, I mean, government was always asked upon that you should not be taxing insurance and medical, while health was largely in terms of services exempt, but insurance of that was not kind of exempt. This council has certainly worded it very well to kind of anything which is individual life or individual health insurance certainly will see an exemption. We'll have to wait and see how the notification gets worded. One ask was whether it is an employee working in a corporate or as an individual, I should kind of be exempt both ways. But maybe, I think we'll have to see the notification. Maybe only the individual who takes it directly from the health insurance companies will be exempt, and companies taking it for their employees will still continue to be taxable. So that's where.
So assuming that both medical and life insurance are proposed to be exempted, there is a view that is being floating around that now if it is being exempted, the corresponding input tax credit is going to be denied. So if it be so, will actually it be a reduction to the consumer, or the cost of input tax credit being escalated will lead to an increase in the cost of services being procured?
Correct. I think that's in fact, the newspaper articles which have kind of come in. In fact, we are also studying a couple of insurance companies that way on what will be the real impact of exemption. It would have been good had the government not exempted it but brought it to 5. At least it would have ensured that the chain continues. But I think government, when they have kind of done this, I'm sure they would have done good amount of study, which is what I believe. So they would have looked at how much is the input tax ratio in terms of these companies, and rather than bringing it at to 5, probably government felt it may be, one is perception value, right? So when you call it as exempt, from a end perception perspective, it feels that government is not wanting to tax. But on the input front, certainly government will kind of earn. And that is where the question is really whether it will kind of lead to reduction is a $1 million question, which I'll have to wait and see how insurance companies will kind of do. But because it's a competitive environment, I believe that insurance companies will really pass on the real benefit. So if we talk about the input tax credit for insurance companies, what is expected was that it is low, I mean it is a little lower than 8%. So something, even if 8% adds to my cost, still what was 18 or maybe 8 could have been, let's say, become 10 from an input perspective. So still there is good amount of benefit which they technically should kind of pass it on to the end consumer. So certainly exempting health insurance will add to a lot of, I think from a perception to the end, this one, it has added to a lot of value. But yeah, realistically in terms of thing, taxing it at 5 would have still kind of kept it at the same. But then taxing at 5, perception would have been a little different, that they have still taxed it at 5. That's right. Likewise for budget hotels also, something which is below 7.5, they have kind of exempted. There again, I think if a landlord has kind of taken the property on, let's say, rent, and rent was, let's say, taxable, because commercial rent now on you'll have to kind of pay tax on. So that will kind of add on. So while exemption is there, but then the ITC locked up through exemption certainly be a revenue which government will continue to kind of enjoy, and therefore really how much it will kind of lead to reduction is something which we'll have to wait and see.
Sure.
That way. So on maybe before I kind of come upon certain reformative changes which government has done, I'll probably just showcase in terms of revenue, I mean how the real impact would kind of be felt. Because from a government's perspective, we know that they are currently earning about 2 lakh crores a month, right? So that's the quantum of revenue which they are earning. How would this rate revisions actually impact the government's kind of what do you say, the net revenue is something which, I mean, I've kind of done. But I mean, before kind of looking at, kind of coming to that, now if you see what government has calculated or kind of done over a period of time is looked at and increasing the base. When GST kind of came in, the number of people registered in GST was about 85 lakhs. And that has kind of grown to about 1.5 crores, right? So the base has nearly doubled. And with compliance rating also, if you kind of see, government has with checker and maker, right? I mean, if only when you file your return will I kind of be able to kind of take credit. So that kind of checker maker which government has kind of brought in through digitization has ensured 96% of compliance, which is highest in terms of any law and in any jurisdiction. So 96% for a standard of that height certainly is kind of very commendable, and which is what kind of government is kind of achieved that way. Now, in terms of the growth also, I mean, if you see when GST got introduced, it was about 7,40,000 crores, and it's grown now to about, previous year was about 22 lakh crores. Now, from a government's perspective, what was expected, 22 lakh crores was expected, like if you kind of look at 12% year on year, it was expected to cross 24 lakh crores. Now, for the first 5 months itself, the revenue is about 10 lakh crores. So that's where we are. But yeah, with these reductions which will kind of happen, we'll have to see how much does it really dent the government's kind of revenue. Now, the total revenue, the cess collection, which is included in this, is about 1,50,000 crores. Now, what the cess will do is, I mean, what I believe is, while tobacco cess continues, the cess other than tobacco gets merged into the the rates. While there is a real benefit in terms of reduction for automobile and let's say certain other cesses, which is, let's say, beverages, that will add in terms of government's revenue. So while net cost to exchequer in terms of revenue remains the same, but real benefit to central government increases to that extent. And over a period of time, with the time, as finance minister has also kind of said, over a period of time, even the cesses on tobacco will kind of be faded away with a kind of a rate which will kind of be inclusive, and that's the time probably we see that the petroleum could also kind of come into the GST net. Now, ironically, if we take, I mean, there was every year the GST issues certain statistics. One of the years they kind of, normally they don't give rate-wise statistics, while government has all the information in terms of HSN-wise, rate-wise, but they normally don't divulge much in terms of how much are they kind of collecting. Now, one of those matrices they had kind of put out saying that how it kind of earns. So the 5% slab contributed about 8%, 12% slab contributed about 11%. 18% slab contributed about 2/3 of the revenue, which is a little above 60%, and 28% slab contributed the rest, which is about 19%. Now, if you're talking of the slab 12 and 18 vanishing, 28, I would say, sorry, not 18, 28 vanishing, 28 will actually get subsumed to 40. So I don't see a while there may be some benefit in terms of the ACs or the cars, but the real collection in terms of cash pool, as the government said, would kind of come in through more kind of consumption. So I don't see a dent as regards 28% slab is concerned. But the 12% slab, if we take 11% of the total revenue, that itself crosses about 2.5 lakh crores. So if the government in terms of this one, they have said that if 12%, let's say, that comes down to half, so 2.5 half is about 1.25 or 1.3, right? So if that itself is really reduced and the benefit is technically kind of done, so that impact should have been about 1,30,000 crores, right? Where though they have kind of choicefully said it should be about 48,000 crores. So that is something which I'm sure the government has those numbers with them, but we'll have to wait and see that whether through ITC restriction or otherwise, are they able to kind of keep that particular pool. So that's where. So, and in terms of digitization also, I think that has kind of ensured what was a chaotic situation when digitization was kind of brought into a controlled situation for the companies and to the end users is certainly kind of wonderful. And all of these changes, I think if government has kind of done these sweeping changes, I would kind of call it, if it was really possible, it is by virtue of hard data which government has. Right? It is certainly, I think this government has kind of shown instances in the past where tough decisions like this are kind of taken, and it is looks like it's, I wouldn't call it as gamble, but it's a calculated move which government has kind of done it at the right time. Right? So from a sentiments perspective, it required boosting, and this kind of reduction, right, while numbers wise it looks like it could kind of be a huge impact, but yeah, as you said, in terms of the ITC lockup or otherwise, how much of that will actually kind of lead to real impact, even if it is 48,000 crores. We are talking of, like say, if you talk about 2 lakh or 24 lakhs per annum, right, 48,000 crores is a huge impact as regards government revenues kind of concern. Sure. So certainly that's the reason I certainly said GST 2.0, if as it is said, certainly is something which is very impactful and kind of felt by everyone.
Sure.
So there are certain other cosmetic changes which government has done. Maybe I'll probably take 5 minutes just to kind of ensure that that kind of done on. Now, one important aspect which government kind of brought about is on the place of supply. Now, there is a concept called intermediary. Intermediary is a person who facilitates or arranges a purchase or a sale. So let's assume that there is a supply of service, let's say insurance itself. There is an insurance supply which happens. A person who's facilitating, the broker in between, is an intermediary. Now, the place of supply for intermediaries was based on where the intermediary is located. Now, that was kind of for intermediaries who were rendering services to, say, non-residents. The fact that they are located in India and their customers were located outside India, their services became taxable. And to the person outside India, it was adding to cost. So certainly that kind of classification was a misfit. representations went in, but from the time this kind of came in, but certainly government probably it looked, or it appeared as if it was thoughtful, and it was kind of getting into, but rightfully now what government is kind of hearing the representations, or probably looking at the global, changed the place of supply. Now for an intermediary, the place of supply shifts from the location of service provider to the location of recipient. Consequent to that, if I am rendering services to a non-resident, what was hitherto taxable now will become export of services. So this will significantly impact the entire segment of those intermediaries who are now focusing to being an intermediary for non-residents. So many, like say, large companies would have procurement arms or sales arms in India, right? Now they can have direct contacts with the entities outside India and earn commission and treat that as services which is exported. So that's a huge benefit which will kind of bring in. This change will come through statute, so we'll have to wait and see really by when it will kind of come in. So I would kind of call it as from a date to be notified is something which this will kind of come in, but it's a really welcome move which this government has kind of brought in, or I would say the council has kind of showcased it. Next important is on the post-sale discounts. Post-sale discount has been a topic of debate and a kind of a pain for most, in fact most number of show cause notices were on certain discounts. So the question, one of the conditions in discount was that when I'm kind of giving discount after the sale, right, was it kind of linked to the agreement of sale or at the time of supply? Now that was a question which kind of made most of those discounts which were kind of given after supply, whether it is eligible to be kind of given as a GST or a discount under the GST law within the time frame given. So that made most of the companies to kind of give financial credit notes or give it in some other manner, which are kind of creating a lot of complexities, be it in terms of reversal of ITC or place of supply and things that way. So what appears to be that after issuing notifications, withdrawing them, issuing circulars, withdrawing them, now they have kind of looks like come to a conclusion on that let us not link the post-supply discount to a sale. Certainly discounts are given. So the fact that I am giving discounts in the ordinary course of my business linked to a particular supply is deductible. But then the million-dollar question would be that for me to kind of give discounts or give credit note still is time-bound. So I'll have to still link it. So how would I kind of break the link is something which we'll have to wait and see. But nevertheless, the intent appears to be to kind of reduce litigation there. As I said, maximum number of show cause notices were on that particular aspect. And here the government has been taking steps which is more in favor of industry. This is one of those steps, or I would say measures which will kind of help the industry. How and what is something which we'll have to wait for the circular to come. But apparently, I think the linking to the sale and ensuring that my customer through the IMS, I'm able to kind of control that if I have given a credit note which is under GST and my customer has kind of reversed it, would be a good kind of compliance that way. And in terms of the rate changes, so wherever the rate changes, the question would be how do I kind of apply, do I apply the new rate or the old rate? In GST we have a 2 out of 3 formula. So you have 3 conditions. One is the supply, the other is for the supply when is the invoice issued, and for the invoice when is the payment kind of received. So if 2 of these 3 events happen before the rate change, that is if the supply has happened before rate change, invoice is raised before the rate change, but payment may have happened before or after, then the old rate will apply. Likewise, if 2 out of 3 conditions happen after the rate change, that is, let's say supply may have happened before, but invoice and payment is received later, or invoice may have happened before, but payment and supply would have happened later, in which case the new rate needs to be kind of applied. So the 2 out of 3 is something which we will have to kind of do, and the industry will have to also look at from an ITC perspective. So wherever the rate has changed, which does not restrict the ITC, there are many questions asked on what will I mean, while there may be some conditions kind of coming in, or rate may kind of make it as exempt, what happens to the credit which is taken rightly at the time when it was taxable? Our view is that when the credit was taken, it was validly taken, so should not kind of impact subsequently. So whatever was validly taken at the time of taking credit should continue to be available even after the rate change, unless it is completely exempt, which requires you to kind of reverse the entire credit which remains in pool. So, and in terms of other trade facilitation, I think government has kind of brought about at least a clear direction in terms of how the tribunal, while it's a mockery in terms of a law that 8 years into GST, we still don't have a functional tribunal. So I think now they have kind of put a clear date that yes, when will the tribunal start functioning and when will the last date for all the backlog be done. Likewise, they have kind of brought about simplified registrations for small assessees, and faster refunds is what they have kind of showcased. Now, we'll have to kind of bring about to see as to how much of that will actually kind of get implemented. So in sum, I would say, Suresh, with the way they have kind of brought about, there are certain reformative changes. Rate-wise, they have impacted all. They have looked at segments which need to kind of be kind of connecting. So the air conditioners, or the, let's say, the television sets, so the cars certainly has impacted the larger or the high paying customers. But the significant impact to the ground, that is in terms of, be it in terms of food, be it in terms of textiles, be it in terms of all of these, where the rates have kind of looked at lower, that is current rate, it has kind of come down, certainly benefits every person that way. So certainly a really wonderful among all 56th council meeting, जैसे it was mentioned, right, Narendra Modi का 56 इंच की छाती है, वैसे this 56th GST Council meeting will kind of be remembered for long. So the sweeping changes which has kind of brought in will kind of certainly benefit everyone, and it's really welcome. And I really applaud the finance minister and every person who's kind of had the courage to kind of do this. And I'm sure industry will kind of certainly the way it will kind of bring in and it will add to the compliance is something which we will have to wait and watch and see. So these are certain things which I felt should be relevant to the audience, and I hope to have kind of covered all of that which I believe is relevant to Suresh.
Yes, Deepak, I think that explains a lot of things that have happened and transpired in the 56th GST Council meeting. Now it's time for some questions from the viewers. The first question that comes in is, what happens to the anti-profiteering mechanism, knowing the fact that the anti-profiteering body's tenure has been completed, and how is the government now going to enforce that the anti-profiteering is not being done by any of the companies?
True. Yeah. No, see, the concept of anti-profiteering was what? If from a value and tax, if there is a tax which has got reduced, the benefit of that should kind of be passed on to the customer. If I can put it simple, let's say if dosa, which was chargeable to tax from a simplicity perspective, I'll take it as, let's say, chargeable to tax at say 15%. So 100 rupee dosa would be charged at say 115 to end customer. Now that 15 rupees, let's assume, becomes 5. So technically 115 should become 105. So you should pass on the benefit. Now when GST law kind of came in, it was regulated that this kind of benefit should be passed on. Now, regulation kind of comes with its own challenges. See, what happens is there are a lot of interdependence. It's just not the outward tax, but there are a lot of inward taxes which also kind of come in. How much of that is the real thing which I need to pass on is a calculated measure. Now, many a times it also leads to unwarranted kind of demands by department to kind of close. So the government, it could kind of lead to what do you say, from a compliance perspective, it could lead to a lot of hardship to the industry. So government has kind of made it as a self-policy, and which is what I think I would say after significant deliberation, government took a right call to call it as a self-policy. So from a customer perspective, it is in your own interest that you will bargain. It's your effective cost, right? You will bargain with the supplier to ensure that his price and his taxes are appropriate rather than government regulating. So here, government would kind of be more in terms of obligating the industry to pass on rather than mandating them to pass it on. So that's a really, I would say, thoughtful decision from government to make it or keep it that way.
Sure, thanks a lot for that. So the next question that comes in is, when there is rate reduction from 12% to 5%, what is the impact of the reduction on the stock in hand, specifically when the difference in the rate is lower than the margin itself?
No, very true. Yeah. So where my product was taxable at 12, now is, let's say, taxable at 5. So there's a straight 7% reduction in terms of outward tax. Many times my margins may not be equivalent to 7. Right? My margins may be only 2% or 3% in terms of the segment. So the rate, which, like say my inventory, I may have an inventory worth, let's say, 1 crore or 5 crores. So just imagine the time I will take to liquidate that and kind of recoup. So if my margins are only 2%, right, I'll have to kind of have twice the inventory flow to kind of recoup or kind of come into that particular space. So certainly the rate reduction has this inherent challenge, but that's how we'll have to live with. But from a planning perspective, if the industry has its choice, certainly from a manufacturer's perspective, he will choose at selling at a rate which is lower, so he will certainly hoard in terms of keeping the inventory after the rate change to bring about the benefit to be passed on. But if he's already passed on to the intermediaries, there will be a pushback saying that let me push it back to the manufacturer so that I kind of don't land up in terms of holding higher inventory cost. But yeah, that's a management which we'll have to, I mean, the industry will have to kind of look at. So I think this will bring about, in fact, the notification should be really out sooner so that all of these, be it in terms of ERP changes, be it in terms of restructuring or kind of the package in terms of MRP, all of that can kind of happen seamless. So all the inventory stock taking, all of that should kind of done, and then the sales returns, right? So it's happening in mid of the year. So the sales return certainly will also have its own challenges because you could have a return which is of an old rate and new rate. So I'll have to kind of keep a tab in terms of which inventory does it pertain that way. So that's a challenge.
So there seems to be 3 questions on intermediaries. The first question is, what led the government to exempt intermediaries?
Yeah.
Second question, what happens to the ongoing litigation as on the date of implementation of this exemption? And the third question is, what happens to the billings when part of the month is exempt and part of the month is taxable?
Correct. So I think on the what made government come so long certainly is something which I'm not privy of, Suresh, but rightly so. From the time intermediary became taxable in GST, representations have kind of gone in. In fact, during MRO activities and certain activities where government, certainly from an export focus perspective, right, this was one question which all the intermediaries would kind of plead to government, saying that please, see, from our services in between, right, when my customer is outside India, don't make it in a manner where he, by virtue of tax, neglects us. Right? If he neglects you for anything otherwise is fine, but tax should not be a reason for you not to kind of avail services. And India was not becoming a choice for intermediaries for non-resident suppliers by virtue of this tax. So rightly, I think they have balanced it. Bringing it to a place of supply based on location of recipient was a right move. Maybe der aaya, durust aaya is what something I would say. Right, a step in the right direction. Rather than looking at what could have kind of happened in the past, I would say from a futuristic perspective, this will bring in lot of, I think, to this segment, it will be a huge opportunity for them to kind of make India shine as regards that particular segment is concerned. I think the next one which you talked about is on the litigation, right? So certainly there was what is intermediary is an aspect, right? So only when I'm acting, like say, mere showcasing some supplier does not make me intermediary unless I kind of induce, facilitate or arrange a sale. So the intermediary is more of a function test. That kind of led to a lot of litigation. So now with intermediary now moving to a tax based on location of recipient will set to right all of those litigations. Right? So I think we can't correct the past, but at least they will be happy that there will be no future litigations on that particular aspect. And third, what is that you raised, Suresh?
The third is what happens when part of the month.
That's also an important. So maybe because intermediary is a statutory amendment which needs to happen in the law, right? So from a timing perspective, I'm just presuming that let's say they bring a mid of the month implementation, then one will have to look at mid of the month being taxable and after that becoming exempt. So they'll have to kind of ensure that their invoices are so done where up to the date when it becomes effective, they'll have to treat that particular activity as taxable and after that as exempt. So for intermediary, there will be, they'll have to kind of bring about amendment in the law. So that may take some time. So we'll have to kind of take it as it may not be effective 22nd September. It will be a date to be notified unless they kind of bring about through some kind of an ordinance.
Sure. So we all know that the removal of compensation cess is a welcome move, except on tobacco. Yeah. Now, what happens to the closing balance of this compensation cess?
So there was no mention on what will happen to closing balance. But if we talk about equity, right? So government was earning 28%, let's say 12% through cess, 40% in terms of tax. Cess input was available only for set off with cess output, and here is a case where cess was kind of going only to state and not to center. So with that being dynamics, we'll have to have a proper transitional provision rules allowing credit remaining on those kind of things to be set off against ordinary tax. So after a particular date, if the compensation cess on inventory remains in balance through specific provision, right, that should be available for set off with ordinary tax. Consider that they don't bring in that, then that becomes a cost. So government will have to bring about, because see, if you talk about aerated beverages, or you talk about let's say anything which was subject to compensation cess, the quantum of inventory will be huge. If they don't bring in transitional provisions, it will have a huge impact. Their margins will be not kind of sufficient to kind of meet the quantum of cess. So industry will have to kind of represent very clearly on proper mechanisms. So it will require proper transitional provisions to allow set of compensation cess with ordinary tax, which could be as GST, more likely than not, which will be available. Whether they will also allow for CGST, something which we will have to wait and see.
Sure. So our next question seems to be coming from a goods transport agency. What happens when there is a switching of option and specifically compliances like Annexure 5, which has already been filed?
Correct. So I think that's also probably a practical challenge. I think one of the whoever has kind of raised this is really very valid, and I'm sure the answer to this will kind of benefit the larger audience seeing here. Now on goods transport, what has happened is I have three options. One is to pay on forward charge or reverse charge. If I'm paying at 5% without ITC, could be forward charge, or there could be a reverse charge which my customer pays. Likewise, the rate, if I take ITC, it moves, the current regime says, moves from 5% to 12. Now that 12 will become 18. Now consider that I had opted for taking ITC at 12%. But now at 18% may not be something which is lucrative. And Annexure 5, which you mentioned, Suresh, has to be done at the start of the year, and it is something which is binding for the full year. And if once you file, no, you don't have a choice during the year to kind of file it again, because it is locked. Right. It's an online filing. So government will have to open this with this change which is happening. Government will have to open. This is another representation which one will have to kind of make. We'll have to wait and see how the notifications kind of come, and if they don't open, we'll have to ensure that the government through representation opens up an option again. So mid-year, whenever the rate happens, they should again allow the GTAs to exercise the option again choicefully, because now it is between 5 and 18 without ITC and with ITC. So rather than kind of compelling them to kind of be forced upon for the rest of the year, they'll have to be allowed an exercise option again mid of the year consequent to this change.
Sure. There seems to be a lot of questions that are coming in. So the next question is, what will be the effective date for change in place of supply rules?
That's right. As I mentioned, it requires statutory amendment. We'll have to wait and see whether they would want to do it through an ordinance or they'll have to do through proper channel. So if it happens through the ordinance, government could choose a date to say, okay, I'll implement it on that date and wait for statutory amendments to happen parallelly. More likely than not, it should happen through the ordinance route is what I believe. But we'll have to wait and see how the government would want to kind of bring about that change.
So this comes from the travel industry, which says, I am working in the air ticketing and other mode of travel booking sector of travel industry. Could you please confirm if there have been any recent changes in the GST rate applicable for commission and ticket based fare?
Correct. So see, the entire ticketing is an agency. Now hitherto consider that for foreign airlines, the agent in India was earning commission. Now based on the place of provision of services, because he was an intermediary, even if I'm earning from an entity outside India, I was treating that to be taxable. Now I'll have to treat my portion of commission to be based on location of recipient, which is the airline which is outside India. So wherever I'm earning commissions or those nature from my customers or the airlines outside India, that will become now consequent to this change, become export of services and not taxable. Likewise, in terms of rates also, right, government has kind of brought about certain rejigs. So certainly if it is a business class, the rate moves from earlier it was 12, now it moves to 18%, right? That is for the airline, way. So not for the agents. But yeah, I think that particular segment, because they're an agent representing the airline, they'll have to pass it on to whatever is the airline charged, they'll have to pass it on to the customer.
Sure. So this seems to be coming from a trade association, which says that 18% GST can't at all be justified on ready-made garments or textiles. Imposing 5% GST on below 2,500 and 18% GST above 2,500 makes garments costlier for everyone and complicates the compliance. We urge the government to adopt the principle of one commodity, one GST rate for all garments.
Very true. I think because garments is something which is very price sensitive, right? So naturally for at a particular segment, price is not the factor, but for a segment which is as low as 2.5 and let's say above, certainly is price sensitive. So a 20%, 18%, I'm just saying, near 20% of tax on garments for a rate which is about 2.5 certainly will make that segment very sensitive, right? So I think representations by garment industry will have to be kind of done. But here again, what I see, Suresh, is government would have thought about, see, when they have kind of implemented such sweeping changes, right? And this is not something which has happened overnight. As Nirmala Sitharaman also has mentioned, that a 2-year effort has kind of gone in coming to this particular kind of change. So certainly every aspect, now all the returns which are filed are on HSN, right? They would have looked at every aspect and then done a choiceful, maybe through representation, at least the value can kind of get enhanced. 2.5 can become, let's say, 5 or at least 10,000 to kind of bring about a particular segment in. So certainly 2.5 appears to be very low, but probably government wants to make more revenue for the loss which is already being done.
So probably for the trade association, this is where the answer lies. Yeah. The limit of 2,500 should be extended to 5,000 or 10,000 so that the trade is not impacted in such bad way. Now, this next question comes from the insurance company, which says, with life and medical insurance becoming exempt, can I delay renewals? So apparently it appears that there are few companies which have already paid the insurance for a 1-year period. Now, can it be revised? Because we all know that medical and health insurance was taxable under the earlier tax regime, but it was restricted for credit under section 17 subsection 5. So can the credit be claimed now, or can it be reversed? Yeah. Partial by way of issuance of partial credit note.
Yeah. So I think whoever has raised this is a very valid, I think I'm sure it comes to everybody's mind. So consequently, when there is a rate change, right, you'll always see, if I have a choice, can I take the benefit? Now, unfortunately, the rates are not dependent on payment, right? So for the 2 out of 3 formula which we spoke about, would be the principle for deciding what rate will apply. Consider a situation where the insurance company has already raised the invoice for a particular period. So invoices have been all done, but the period of the invoice, they have raised it in, normally what happens, it's always in advance. So the term is always in advance, and the invoice or the renewal notice kind of comes in advance. But I have a 30-day window or whatever window to make the payment. Now, if that window falls after, let's say 22nd, just because I'm paying after 22nd does not make that I will be entitled to lower rate. Rate is already fixed because for that rate was the old rate. What the insurance companies, will have to do probably is they may break the term, because normally the segment works for an annualized basis. They could look at exploring, because this is a benefit which I need to pass it on to the end customer, right? So if I'm the end customer and if invoice is already been raised and insurance premiums are already done, that has already suffered 18% tax, right? Choicefully, here again, they could also take a suitable clarification from the board, but I certainly believe that this is workable. What they could do is break the period of the insurance to a period where it is before and after rate change, come out with one invoice for the period prior to when it was taxable, that is up to 22nd, and a rate value which is after 22nd. For the period after 22nd, they could kind of look at treating it as 0 rate. And if the end user, that is the consumer who's paid the premium, has already paid higher, that will be available for next renewal. Right? So certainly, but that means a lot of paperwork, right? So I don't know whether insurance companies will be actually willing to kind of do that particular task, but theoretically it is possible. So they could break the annualized premium to a period which is up to the rate change and then raise separate invoice. But if that is not done for the end, if I'm the consumer, then I'll just delaying the payment will not give me the benefit of rate change. I'll have to look at was the insurance premium due before 22nd, and has the invoice or the reminder come before 22nd, then it is taxable. And if it is coming after, then it would certainly come in with exemptions in terms of rate.
That clarifies a lot for the insurance premium that has already been paid, and the invoice also has been raised. Yeah. Now, I got a new health insurance done on 31st August 2025. Am I eligible for refund of tax?
Correct. Which is exactly what I did mention. So for all those who have already paid, what the insurance companies could look at, it's a possibility that because it is an annualized period, it's a continuing period. So it covers, let's assume in this case, from 1st September to 31st August of next year. So the period, let's say from 1st September till 22nd is a taxable period, and after 22nd is a exemption period. So it is for the insurance companies to revise that particular annualized into these two halves. So they'll have to raise for the taxable period one invoice, and for the non-taxable period another invoice. There is where the benefit can kind of come. We'll have to wait and see whether insurance companies actually do that.
Sure.
But that will mean a lot of paperwork, which I believe for smaller consumers, no, they may not be interested in doing that.
Absolutely. So this question is coming again and again. If life insurance premium is due before 22nd September, but paid after 22nd September. So there also the clarification seems to be, since two of the events are happening after 22nd September, there is a possibility of claiming the exemption.
Yeah, if two happen before, then taxable. Two happen after, then claiming exemption is there possible.
So how will the inventory and sales return be treated when tax rate change mid-cycle?
Tell me again, Suresh.
This seems to be a query where the inventory and sales return be treated, but tax rate change.
Correct. So see, that's the catch. Now see what's happened when I'm doing a sales return. Consider it as a common kind of stock. Now I'll have to then watch to see when I'm returning to which batch it pertain to. Batch pertain to the old rate or the new rate. If it is the old rate, then I'll have to ensure that the sales return follow the higher rate from a credit note or a sales return perspective. And if it is pertaining to an inventory which is after the rate change, then I can take the benefit of the lower rate. So keeping kind of a bifurcation and control on the nature of inventory will be very critical. More likely than not, if you don't have that control, the assumption which the people will do is to allocate it to the period after the rate change, which may kind of be incorrect. So one will have to keep a clear record. Does the return pertain to an invoice which is before rate change or after rate change?
So here seems to be this compensation cess, I think, which we have already addressed. The person is asking what will be the impact of removing compensation cess on sectors like motor vehicles and carbonated beverages.
Yeah, so the million-dollar question which these guys will have is there is a huge cess which is lying in balance. What will happen to that? So that we'll have to wait and see in terms of the transitional provisions, which kind of similar to transition provisions, right? We'll have to kind of be worded for them to whether they will allow the cess remaining balance to be set off against the SGST component. More likely than not, that is how it will kind of come in. And if it does not come in, they'll have to represent to kind of get it, because otherwise it will add to cost.
Right. So here also the same compensation cess again automobile sector, since there is no cess payable for outward supply after 22nd. So we'll have to see the transitional provisions that come in for compensation cess, and that will answer, I think, most of the questions relating to compensation cess. So this question is also repeated, where we have clarified that what happens in case of an intermediary providing services to a non-resident customer, how should it raise its invoice for the month of September, considering place of supply rules are notified with effect from 22nd September.
Yeah, so that is on the assumption that this may bring or get into force on 22nd. Good possibility that it may not happen on 22nd because this is a statutory amendment. So maybe we'll have to wait and see when will it kind of get notified. Consider that it gets notified on the start of the month, then we don't have a problem. But if it gets notified mid of the month, then the person who's raising the invoice will have to break for the period it became taxable and for the period after it became treated as exports, right? So if it is mid, let's say the example itself, 22nd September, so I may have to raise one invoice for 1st September till 22nd, and for the period after, that is 23rd September to 30th September.
So the answer lies in the fact that for if the rules are notified in middle of the month, there may be two invoices to be raised for that month. One before the taxability, one before the exemption.
Yeah, being treated as exports.
Being treated as exports. So rate reduced 12% instead of 5%. Can avail previous ITC adjusted?
Yeah.
Yes. So ITC can be adjusted, I think. You can answer that.
Yeah, absolutely. So that I think we covered that in our presentation as well. So if there is if there were, at the time when I took ITC, maybe my outward was taxable at 12. Just because it is changed from 12 to 5 does not impact my previous ITC. I can certainly continue to avail, just that it gets, maybe I may have longer period for utilization, but certainly available without any restriction, hopefully.
So we have many more questions, but I think we'll take the last two questions for the day, and we will resume once the notifications are in place. We will come back to all the other questions. Inventory of FMCG products are lying with thousands of point of sales. It will be practically very challenging to change the MRP for each SKU at each place of supply. Any alternative solution?
This was something which, when GST came in, again at the time also, this was something which was there. So this is part of business, I would say. See, rate changes are something which happen from a particular date. I think we, fortunately, under the legal metrology law, earlier I had to kind of send it back to the manufacturer for relabeling. Now even the stockist can kind of do relabeling following certain defined processes. So I think we'll have to do the relabel and then follow that. So with relabel, revised MRP will have to be kind of done. Whoever is the manufacturer, I'm sure he will have control over the points of distribution, and at those appropriate stickering will have to kind of be done to give effect to this rate change. Unfortunately, sending it back to manufacturer is not a choice. Keeping it with you and stickering probably is the most practical aspect, I would say.
Yes, absolutely. So there is an user which is requesting that please answer my question. Will introducing two GST rates reduce disputes and improve ease of doing business, especially for schemes like buy A, get B free?
Yeah, I think that's a, maybe I get what you're saying, Suresh. Whoever has asked this is really, I'm sure he's wanting to touch a particular kind of aspect. Let me illustrate this with an example. The two things which is asked, one is in terms of two bucket rates, and the other is in terms of rates which kind of come in with certain schemes. I'll touch the scheme first and then the buckets. So many of the schemes which run, let's say talcum powder and skin, both consider that when I'm selling a talcum powder and let's say a skincare kind of cream, consider both were taxable at 18. So you buy one, get the other one free. So irrespective in terms of change rate would not have made a difference, because both were, what was given free was also taxable at 18 and what is being sold is also taxable at 18. But consider a situation where what I'm selling, let's say the skincare cream, reduces from let's say 18 to say 5, and what is given free continues to remain at 18, which is what he's asking. What will happen? Will it become a mixed supply? Sure. By virtue of me giving free, will the entire value become taxable, right, or get taxed at 18? So that's the catch. So I think we will have to kind of change the scheme is what I would want to say, because you can't have something given free taxed at higher rate and something which is sold taxed at lower rate, because that will kind of create clear mixed supply issues. So the industry there will have to bring about, if schemes are already kind of introduced or announced, it may require rejig to kind of bring about parity, or otherwise offer it to tax at full 18 that way. So or maybe break that into not a free case but a sale case, that is I'm selling A and B at defined values. That will kind of also kind of bring about. And the two bucket, Suresh, I think that's what. Yeah. So I think that was, I think, a very bold move from this government. Yeah. In fact, it was not thought about. Most people in the industries as experts who were kind of always talked about a three rate structure. That is 5, 12, 18, or maybe somewhere between in terms of that. Even Arun Jaitley, in many of his vocal statements, he would say you can't have from a taxing perspective, you need to have multiple rates, and probably 3 or 4 was considered to be reasonable. A 2-rate structure, which is 5 and 18 largely, certainly is really a wonderful move. Significantly will bring about reduction in disputes, because most are taxed, be it in, like say if it's automobile, right, parts and automobile are grouped under one. So litigation is intended to kind of come down. Likewise, everything coming down to 5 again will kind of bring down. So lower the rates, lower the classification disputes coming down. So that's a straight saving in terms of disguise going otherwise kind of litigating with the department is a huge kind of time and energy there.
Sure. That explains a lot. Now the final question for the day. Please explain in detail section 14 of CGST Act in regard to supply of services in regard to reduction of rate of tax. And the same question seems to be coming again. I have raised an invoice at 18% GST before 22nd September, but my supply and customer payment were completed after the rate was reduced to 5%. How can I benefit from the reduced rate of tax? As Deepak has already confirmed that 2 of the events are happening post 22nd September. Therefore, you have the opportunity to claim the exemption. So please explain in detail section 14 in regard to the amendment. How does it impact? So please explain in detail section 14 of CGST Act in regard to supply of services in regard to deduction of rate of tax.
We are not getting the question there, Suresh.
So I would request the viewer to please join the WhatsApp group that is given in the link in this video, and please do post in your question there, and we'll ensure that we get this question passed on to the expert and revert to you with the answers. Request everyone to please ensure that you join the WhatsApp group and be connected to the Optotax platform. Thank you. Have a great day.
Wonderful. Yeah. Well, thank you so much, Suresh. I think really it was wonderful engaging. Thank you for this opportunity. Really loved the interaction.
Thank you.